Welcome back to Wall Street Podcast. Today, we're diving deep into some crucial insights for asset allocators, pulled directly from a recent Bank of America Global Research report.
That's right.
We're breaking down their quick RIC, top FAQs, and a mid-year review, which just came out July 9th, 2025.
Fresh off the press.
Exactly.
Okay.
And this report, it's really a shortcut, isn't it? Condensing key questions, giving beta-backed answers from BofA Research. It gives a sharp outlook on current market dynamics.
Precisely. For anyone navigating today's complex investment landscape, this deep dive should really give you the market's pulse.
Yeah.
Especially after all the volatility we've seen this year.
Yeah, equities, bonds, currencies.
Yeah.
It's been quite a ride.
It has. And yet, many markets are still trading near record highs. BofA, they consistently highlight their preference for value and quality in equities,
Okay.
prudent yield and fixed income, and, inflation protection through real assets and commodities.
All right, let's unpack this straight away. The first two big questions on everyone's mind: global growth and the impact of tariffs. Where does BofA stand?
Okay, starting with global growth. BofA economists, they're projecting a pretty stable 3.0% global GDP growth for both 2025 and 2026.
30%, okay.
Right, ticking up just slightly to 3.3% in 2027. And global inflation, they expect it to hover around, say, 2.5%.
Manageable.
Seems so. For the U.S. specifically, the outlook is described as, well, muddling through.
Muddling through, I like that.
Yeah, they think fiscal stimulus and tax cuts will eventually offset the tariff impacts. But here's where it gets really interesting. Their interest rate forecast.
The Fed.
BofA is standing firm. They anticipate no rate cuts from the Fed in 2025. None, because of inflation pressures.
Drizzle sticky.
Exactly. With maybe 100 basis points of cuts a full percentage point possible, but only in 2026.
That stance has definitely been out of consensus, but it's been accurate so far.
Mm.
Which brings us to something you mentioned BofA highlights. The Fed's dot plot being unreliable. Can you quickly explain the dot plot and why its unreliability matters?
Absolutely. The dot plot is basically the Fed's chart showing where each policymaker thinks rates will be in the future. It's a snapshot of their individual forecasts.
Right, the dots represent people.
Correct. And BofA calls it unreliable because, historically, actual policy changes. While they often deviate quite significantly from those plotted projections.
There's no bank on the dots.
Pretty much. It might give you a general direction, maybe, but it's not a precise roadmap for timing or how big the rate moves will be. Understanding that is crucial if you're relying heavily on those forecasts.
Fascinating point. Okay, shifting gears then to tariffs. Are we seeing them visibly hurting corporate profits yet?
Not yet. Not in a, broadly material way across the board.
Still early days.
Seems like it. U.S. Customs data for May imports showed an effective tariff rate of 9.5%. That suggests we're kind of settling into a new normal there.
9.5%.
Yep. The full effects are still expected, maybe more in the second half of this year, but the evidence right now is mixed.
How so?
Well, for example, BofA's truckload demand indicator actually rebounded to 54.9. That signals better shipper confidence.
That's positive.
It is. Yet, Andrew Obin's Fluid Power Survey doesn't really point to widespread demand destruction or a big macro rebound just because of tariffs.
So, conflicting signals.
Exactly. And here's a crucial number. BofA's U.S. equity strategy team, they only expect 3% profit growth in 2025.
Only 3. That's way below the street, isn't it?
It's significantly lower. The bottom-up analyst consensus is around 9%.
Wow.
But what's intriguing is the market might be looking past it. U.S. earnings revision ratios. They show 1.15 times more stocks with rising estimates than falling estimates. That's a 10-month high.
So individual company stories are improving even if the overall picture is muted.
That seems to be the takeaway. The market might be focusing more on specific company execution right now.
Okay, so the hard data isn't flashing red on tariffs yet. But that raises a really interesting question. Why are sentiment surveys still so weak?
Yes, that disconnect.
Right. If the data is stable, why are investors, consumers, companies, why are they still feeling so bearish?
And that disconnect, that might actually be the best reason for some bullishness in the second half of 2025.
Interesting twist. Explain that.
Well, the hard data, things like production, employment, it's stable. Actually, it's about 0.3 standard deviations above the long-term average, so resilient.
Okay.
But the soft data, the sentiment measures like ISM new orders, consumer confidence, they're way down. About 0.6 standard deviations below average.
Big gap.
Huge gap. So a rebound in just expectations, just sentiment catching up, could be a major catalyst for market upside.
So it's about perception shifting.
Precisely. And leading indicators are already hinting at more stable manufacturing sentiment ahead. Plus, the University of Michigan Consumer Survey looks like it might have bottomed out.
So the worst of the pessimism might be over.
Could be. It's something to watch very closely.
Definitely. Now let's talk equities. After this incredible run of U.S. dominance since, 2018? Is 2025 the year global equities finally take the lead?
Well, for the first time since 2009, global equities, excluding the U.S., are actually on track to outperform the S&P 500 this year.
By how much?
By a significant 11 percentage points year to date.
11 points. That's substantial.
It really is. And Michael Hartnett, BofA's chief investment strategist, he suggests this multi-year outperformance of the U.S. dollar and U.S. equities. It might be ending.
Why now?
Several reasons. Valuations are more stretched in the U.S., number one. Number two, there's likely a fiscal impulse shift coming away from the U.S. towards the EU and China.
Okay.
And number three, frankly, there's a need for a weaker dollar to help finance the nearly $40 trillion U.S. public debt.
40 trillion. Yeah, that needs financing.
Doesn't it? So while a full rotation takes time, the trend seems pretty clear, even though U.S. ETFs are still seeing decent inflows.
Fascinating shift. And within that potential global move, what about value versus growth? This always gets investors talking. Will value keep outperforming?
Absolutely. And yes, this is a critical piece of the puzzle. In the U.S., if you look year to date, the Russell 1000 value and growth indexes are roughly neck and neck.
About even. Okay.
But look at the spring sell-off. Value stocks declined by only half as much as growth stocks did.
The risk-adjusted return.
Exactly. That makes value look much more attractive on a risk-adjusted basis. BofA's U.S. equity team remains overweight value.
Why specifically?
They cite better relative returns if we get stagflationary risks, lower betas meaning less sensitivity to market swings, and crucially, value stocks today are actually screening as high quality.
Value and quality together.
That's the sweet spot they see. And globally, the outperformance is even starker. Value has beaten growth reliably since 2000.
By how much?
Over 4 percentage points per year in Europe, 6 percentage points in Japan and APAC, and a whopping 8 percentage points per year in emerging markets.
8%? That's huge.
It's a very consistent long-term trend outside the U.S. For investors looking to play this, POF mentions funds like Invesco S&P 500 Enhanced Value ETF, that's SPVU.
SPVU, got it.
Putnam-focused Large Cap Value, PVAL, and Invesco S&P 500 Pure Value RPV.
Good specifics. Okay, let's pivot now to some sector-specific catalysts. Deregulation is a theme we hear about. Is that potential already baked into stock prices in key U.S. sectors?
Not yet, according to BofA, and that's where they see significant potential upside.
Really? Which sectors?
Savita Subramanian, their head of U.S. equity strategy, points to heavily regulated sectors: consumer, commodities, and financials. She notes a strong correlation between regulation levels and valuation multiples.
Meaning less regulation equals higher multiples.
That's the implication. The bull case for deregulation isn't fully priced in yet. Ibrahim Poonawalla, their banks analyst, sees a clear regulatory shift underway for banks with real EPS upside potential.
And beyond financials.
Andrew Obin, covering multi-industry, believes deregulation at federal agencies will speed up power generation projects. There's already something like $25 billion under construction that could benefit.
How does that work mechanically? Less red tape.
Basically, yes. Reduced compliance costs, faster project approvals. It frees up capital, lets businesses operate more efficiently. That flows directly to earnings and should support higher valuations over time.
Makes sense. Okay, next up, a red-hot topic. Artificial intelligence. Is it overhyped as an investment theme? Has the train already left the station?
Not yet. Not according to BofA. They argue it's not overhyped. Business adoption is just accelerating incredibly rapidly.
Got any numbers on that?
Yeah, quite striking. Over 9% of U.S. companies are now actively using AI tools. That's up from less than 4% just 2 years ago.
More than doubled in 2 years.
Exactly. So BofA analysts are bullish on both the AI providers and the AI users.
Okay.
Brad Sills sees digital agents as a major way companies will monetize AI. Vivek Arya is mapping out a path to a $1 trillion global data center market by 2030, largely driven by AI needs.
$1 trillion.
It's a huge number.
Yeah.
And Alex Stranahan's research highlights AI's impact in healthcare, making personalized medicine more effective. One study even showed nearly doubled survival rates.
Doubled survival rates? That's incredible. That's tangible impact.
Absolutely. This isn't just abstract tech anymore. It's delivering real-world results.
Sticking with big shifts, the recent NATO agreement, there's talk of a 5% of GDP defense spending target by 2035.
Yeah.
Is that credible? And what does it mean for investments?
Both have used that 5% target as credible, yes. It signals an accelerating global commitment to defense spending, a long-term trend.
So more money flowing into defense globally.
Definitely. Analysts estimate European defense companies alone could grow at an annualized rate over 12% through 2028.
12% growth. Who benefits most?
Well, U.S. suppliers will still be important, naturally, but both estimates that maybe 80 to 100% of the near-term incremental spending could actually stay within Europe.
Interesting. Focused on what?
Things like electronics, advanced air defense systems, and also new tech drones, cybersecurity.
So traditional defense and new tech.
Right. For investors wanting exposure, they highlight the Global X Defense Tech ETF, ticker SHLD. It has a significant 40% allocation to Europe and the UK, and it invests in both the big defense primes and those cutting-edge new tech companies. Captures both sides of the trend.
Represents a long-term secular growth story then.
That's the view.
Okay, finally, on sectors and market caps. We've talked large caps, global shifts. What about the smaller end? Small and mid-cap stocks, SMIs, they've been lagging. When is that tear time?
Yeah, SMIs are definitely in an earnings recession right now. They've lagged the S&P 500 by about 7 to 9% year to date.
Ouch. So what's the catalyst for them?
Consensus expects an EPS rebound for them this year. But the major catalyst everyone's watching for is a clear signal of interest rate cuts from the Fed.
Rates again. Why are they so sensitive?
Jill Hull's research at BofA shows small-cap valuations are now more negatively correlated to rates than ever before.
Meaning lower rates equal higher PE multiples.
Directly. Lower bond yields would give their valuations a significant boost. But here's a really critical distinction BofA makes.
What's that?
It's crucial for you as an investor to watch the right index.
Not all small cap indexes are the same.
Not at all. The Russell 2000, the one most people think of, it actually has near-record exposure to unprofitable firms right now.
Not ideal.
Definitely not. But the S&P 600 Small Cap Index, its exposure to unprofitable companies is near-record lows.
So much higher quality exposure with the S&P 600.
Precisely. And interestingly, within the SMID space, mid-caps and growth have actually been a winning combo so far in 2025.
Which funds capture that?
Funds like the Vanguard Mid-Cap Growth ETFs, that's VOT, and the iShares Russell Mid-Cap Growth IWP, both have outperformed.
VOT and IWP. Good to know. So for SMIs, watch for rate cuts and be selective about your index.
That's the bottom line.
Fantastic insights. Okay, let's shift gears completely now to fixed income. With all these ongoing deficit fears, are bonds just going to keep lagging equities?
Yeah.
And what about that end of 60-40 idea? Still relevant.
The answer from BofA is probably yes. Bonds likely will keep lagging equities.
Not great news for bondholders.
No. Mark Cabana, their head of rate strategy, and his team, they expect the U.S. 30-year Treasury yield to stay persistently high, around 5% by the end of 2025.
5% on the long bond.
And Posiani even points to risks of spikes higher, maybe to 5.3% this summer.
Wow. Why so high?
Well, fiscal discipline seems unlikely, right? More debt issuance is coming. And critically, big asset managers are wary of treasuries because FX hedging costs are so high.
So who's buying them?
That leaves U.S. households as the crucial, maybe the main consistent buyer. The stark reality, as BofA puts it, is that treasuries are stuck in a multi-year bear market.
Which really reinforces that end of 60-40 view, doesn't it?
It absolutely does. That traditional 60% equity, 40% bond portfolio just isn't delivering reliably anymore. It forces investors to search for, well, more prudent sources of yield.
Okay, so if 60-40 is challenged, what are these alternative, more prudent yield sources BofA recommends?
Their dynamic prudent yield strategy is a key example they highlight in this July update.
Dynamic prudent yield. How does it work?
It's a rules-based fixed income strategy. It's designed to rotate between different types of income assets based on market conditions. And for July, it's rotating out of cash and into preferred stocks.
Preferred stocks. Interesting. Has it worked?
The track record looks pretty good. It returned 6.9% over the last 12 months.
How does that compare?
Comfortably outperformed the U.S. aggregate bond index, which was 6.2%, and it absolutely crushed the iShares 20-plus year Treasury bond ETF, which only returned a meager 0.2%.
0.2% versus 6.9. That's a huge difference.
It really demonstrates the value of active management, or at least dynamic allocation, in today's bond market. The ETFs currently used in that strategy have an average yield of 5.2%.
So finding yield strategically, not just passively holding treasuries.
That's the idea.
Very compelling in this environment. Okay, one last look at the report. Overall ETF valuations. Where are things trading across the market? Expensive. cheap?
Well, the median equity ETF in BofA's coverage universe trades at 15.5 times expected earnings.
How does that stack up historically?
It's about zero point 0.6 standard deviations above the long-term average of 14.5 times. So a bit more expensive than average, maybe, but not wildly overvalued on a median basis.
Any pockets of extreme valuation?
Yes. Aerospace and defense, including that defense tech we talked about, that remains one of the most expensive parts of the market, trading at a hefty +2 standard deviations above its average.
2 standard deviations. Quite rich.
Very much so. And interestingly, all U.S. sectors are trading at or above their historical trends right now.
Everything's elevated.
Pretty much. The only areas trading below their long-term norms are U.S. small caps, small cap value, and international dividend strategies.
So small caps still look relatively cheap.
Relatively, yes. And one final interesting point on valuation. Quality factor valuations have actually surpassed growth factor valuations on a standardized basis.
Quality's pricier than growth now.
On a relative historical basis, yes. And strategies focused on dividends and buybacks. They're trading closest to what BofA considers fair value. Tells you where the market sees relative safety, perhaps?
Fascinating snapshot. Okay, that was an incredibly rapid-fire download of Bank of America's latest market review, packed with insights. Let's wrap this up with 3 critical questions for you, our listener, to really chew on as you digest all this information.
All right, first question to consider. Given those mixed signals we discussed, the disconnect between profits, sentiment, hard data, how will you weigh that soft survey data against the hard economic indicators and earnings forecasts when making your investment decisions for the rest of 2025? It's a real balancing act.
It really is. Second question. With that clear shift towards global equities and value stocks highlighted in the report, what adjustments might you consider for your portfolio, especially if you've been heavily weighted towards U.S. large-cap growth for the last few years? This trend could seriously reshape returns.
Definitely something to think about. And finally, number 3. Considering that persistent bear market in Treasury bonds and the whole end of 60/40 view, what alternative fixed income strategies, maybe something like BofA's dynamic prudent yield or others, will you truly prioritize in your portfolio over the next, say, 12 to 24 months? How will you ensure you're capturing income efficiently and effectively in this really different environment? Some important things to mull over.